Welcome to the Passive Income Podcast. I'm your host, Dividend Dave. Please be sure to hit like and subscribe below and join the Passive Income Posse. Super excited for this episode. Joining me is Danny. You can find him on Twitter or X, whatever you're calling it, at Ultra Runner 26, I believe is your handle. Danny, please go ahead and give yourself an introduction.
Awesome. Thanks, Dave. Yeah. You know, glad to be on and glad to get to talk to a lot of you about a little bit of, ultra running and as well as the dividend investing community. It's a great community. It's how Dave and I got together and met each other and met a lot of great individuals. And it's great to kind of follow everyone's journey as we keep moving forward.
Yeah, exactly. That's great. And I couldn't agree with you more. A lot of great people in the community. I've had so many of them here on the Passive Income Podcast, and I've talked to so many. And so thank you for becoming one of those people to join me here. I truly appreciate you spending some of your time with me.
Yeah, absolutely.
So let's get right into it. I guess let's first start with the running side of it because I have seen a couple of your tweets where you're like, my Twitter feed is kind of perfectly the way I want it right now. With half your running content and half investing content. So it's obviously those are like, or it seems like two of your passions, right? So and you've just kind of been able to almost divide that 50-50 where you have your running community combined with your investing community.
Yeah, no, originally when I joined X, it really was just for the running community, just try to, learn about other runners and learn about some races and things like that were coming up, and that's really how it started, and I think the part that started to stand out to me was just the individuals that one would reach out looking for advice or things on how to approach training or approach specific races or things like that. And so, that's kind of what really brought me into X, and just the overall community of running. Then after that, as you start to grow that community, it just becomes really great to see just every individual and how they kind of progress and see their stories and, see someone that really went from not running at all to suddenly they're running their first 5K to their first half marathon, and then people just accomplishing huge feats that they never thought they would. And I was just reading about somebody the other day that just accomplished their first 100-mile race, which again is a huge running accomplishment. And so that's really the part that I enjoyed a lot, was just kind of following the path of every runner, because that is what makes running amazing, right? It doesn't matter if you're fast. It doesn't matter if you're slow. Running is just about the fact that you get out, you do it, you try, and it's all about your own personal accomplishments and what you can do. And that's the part that I really love about running. So I think that's really what brought me into X at that point. I'd always kind of been into the investing community side of things. Didn't really have a community though yet. There was a few names that started to pop up here and there, and it's crazy how just a few names suddenly grows into the community that we are today. Again, meeting a lot of great individuals and talking through some names, and I remember talking with SCHD Greg, right? That was kind of one of the first names I remember see pop up on X, and him and I kind of went back and forth for a little bit, and then Dividend Dog, and we connected as well, and so that's kind of how it really started. Was just with a few single names, and I would say SCHD was probably one of the first ticker names that I think probably brought me into meeting a lot more individuals on X, on the investing side. And then after that, I just realized that, I loved the balance of having kind of, like you said, that 50-50 split of the investing community as well as the running community. I still think I'm probably a little more runners on that side of things than the investing, but I'm trying to grow that investing side a little bit more as well. But yeah, it's X is amazing. It's great to just follow not everybody's running journey, but seeing all the investing journey paths that people are going on. And I love watching people share goals and things like that, or when someone finally crosses that goal that they've been shooting for a certain share count or dollar amount. that dividend threshold that they finally cross over that they've been working at for a while. So I think that's what makes it fun, is just supporting each other and going step by step. It's there's been some pretty big things that I've seen lately of people crossing 1,000 share goals and things like that lately, which has been pretty cool to see.
Yeah, exactly. Very cool to see. Can you still hear me okay? I feel like some of your audio has been cutting out a little bit, but I think if we're still good, we'll just keep going.
Okay, yeah, I can hear you.
All right, good, good. So yeah, those goals and like you said, seeing people cross those thresholds are uh, one, great to see, very motivating as well, motivational for you, kind of like, hey, if they can do it, I can do it too. And yeah, that's I guess just sort of my 2 cents to add to that comment of seeing people cross these goals and thresholds. And you also mentioned sort of the, some dividend goals too. Is that a big part of your investing strategy? Because obviously it's a big part of mine, right? That passive income and making, having those dividends roll in monthly, quarterly, whatever it may be.
Yeah, it really is for me. Obviously just reinvesting at this point, but that I think that's really kind of how it started. Really was with the SCHD community, right? After I'd done a lot more research and things like that, I really dug into DGRO, which actually became my number one position after that. Just because looking at the fund rules and looking at the fundamentals of that fund. Um, you know, what's required to be inside the fund. I just love the principles. I love the kind of the rules to be in it and how to stay in the fund. I like seeing kind of that tech exposure that DGRO really brought to the table versus a little bit of lacking within that with SCHD, a little bit more of your bigger names, but lacked a little bit of tech exposure, which is really what I enjoyed about seeing that in DGRO, with obviously having a very healthy 10-year dividend CAGR. Well, I guess I should say 9-year dividend CAGR, since the fund has only been around 9 years. So I think this year it finally crosses that 10-year threshold, and we'll get that 10-year data. But DGRO has been just a phenomenal fund. Its growth rates have been tremendous from a dividend standpoint as well as the growth rate standpoint. And so, those two are really my cores. SPLG is another fund that I absolutely love. This is a fund that I'm continuing to grow out. We hear a lot about VOO, right? I think VOO is probably one of the most talked about ETFs out there. SPLG is literally the exact same fund as VOO. I think it's a 99.9% fund overlap, so it's pretty much the exact same fund. It's going to be a hair cheaper for you though, and so that's going to be the next one kind of on my list. There is I've been starting to build that one out to just kind of bring it together with DGRO. But I think the dividend goals, I think, is what makes it fun, right? I think it's what really keeps you in and seeing that growth and it starts out with, again, I think that's what makes the X community great with dividend investing is just watching that individual try to shoot for their first $100 a year in dividends. And next thing you know, it just honestly feels like, months later, and someone's talking about now they have $1,000 a year in dividend income, right? And then you have some people that are, pushing 500 a month or 1,000 a month. And so it's just cool to watch the path of everybody, and everybody's a little bit different, but we all have our own goals and milestones, and I think that's what makes it fun. I like seeing kind of that next step each time as you cross each threshold.
Yeah, so you mentioned a lot of the different funds there, like SCHD and VOO and DGRO. So is that more your strategy to go to the index funds and the ETFs as opposed to trying to pick individual stocks?
Yeah, I think I approach it in a little bit different of a way, I guess you could say. I like to think of my portfolio as more of the core and satellite approach to things. So all my ETFs will obviously just remain my cores. I like to have kind of three main cores, which, again, are focused around either a dividend growth ETF, as you mentioned, like a, a DGRO or an SEHD, still having kind of your S&P 500 fund that's in there as well. I'm probably a little bit more doubled up, but I'm doubled up in a way that I think balances it out with the DGRO and SEHD. There's a little bit of fund overlap there, but with DGRO having obviously 500 holdings versus, SEHD is only about 100 or so, you're not getting a ton of overlap there. So I take that approach where I kind of have my 3 core ETFs, and then I have really my satellite positions that really add on top of that. And so these will be a little bit of like your bond funds as well as, some individual names outside of that. I try to keep my individual names really close to that, I'd say 5 to 10 number as far as individual companies outside of ETFs. And then I like to, I would say I still keep a good 5% or so to your more speculative and, risky stocks, right? I think that's also what keeps it fun and interesting, right? Is hopefully maybe you get one, maybe you don't, but that's the risk you're taking. And so, I think keeping a couple percent for some of those that might turn out to be something great. I like to keep a little bit of that. But yeah, I would say, I'd probably say at least 80% is going into core ETFs, with only about 10 to 15% going into satellite positions and, a couple percent into, more risky speculative plays outside of that. I think for the most, I'd say typical investor, somebody that's just getting started, that's typically what I would recommend to folks is, I do think the ETF route is a lot better route, in my opinion. That's what I like to do. It's a lot less research, it's a lot less time listening to quarterly earnings and following the business. That's one thing I do see in the X community sometimes is, you got to avoid following the path of bouncing from company to company and just buying a little bit of everything here or there. Because in my opinion, what it turns into is you got 50, 70, 80 positions of just tiny little slivers of each one of them versus, really building out a healthy core position of a business model that's successful, right? When you think about really growing a position, you really want to just stick with those companies that are truly growing. Have all the metrics that are, I'll use Costco as an example. Obviously a great business model, tremendously well ran company, numbers across the board. I don't think anybody can argue it's a great company. Is it trading at a rich multiple? Absolutely. I actually think it's trading at probably one of the most rich multiples of any retail stock out there today. You're definitely paying a premium for Costco. But my point is those kind of companies are the ones that, instead of owning half a share, but you got 40 other positions, for me, I'd rather build out the position of a healthy company and make it a much larger position, knowing that the numbers prove themselves out long term to really grow, right? If you look at Costco over the last couple of years, you'd be up a couple 100%. Versus just picking 40 random slivers of a company that you might be up 5% on a very small position. So I believe in concentration of good businesses, grow them to larger positions and hold them.
Yeah, I couldn't agree with you more there. And I do find it's a very slippery slope and it's very easy. Like my watch list, there's got to be 70, 80 on my watch list. And even there's times where I have to go through my watch list and just be like, okay, I'm never buying that. I'm never buying that. Just even get it off your watch list because like you said, it doesn't make sense to hold half a share of something or half a share of 40 different positions when you could pick, say, 2 or 3 of those 40 and just really focus on building up a core position in those 3 or 4 individual stocks. I think Costco is a prime example because it is an expensive stock. I'm not sure exactly what it's trading at right now. But yeah, to buy one share, what is it? $600, $700, somewhere in that range.
And I think it's trading around a 55 multiple. So I mean, you're paying tech valuations on a retail company, which is
right.
That's a premium multiple for sure.
Yeah. So yeah, I would say that's very difficult. And like I said, it's a slippery slope because you can get going down this rabbit hole where you're trying to buy, you're like, oh, I like that company. Oh, I like that company. Oh, I like that company. But yeah, because I've had other people on here too. I not gonna name names. They know who they are that hold these, 40, 50, 60 positions. And I just find it mind-boggling. Like, how do you do that? How do you keep track of everything? And how do you grow positions in all of these different companies, right?
Hmm.
So, and even myself, people know that I'm sort of in that 25-ish ballpark. And that to me, I think that's too high. But I do still keep seeing more companies that I want to buy. And I'm like, well, I probably need to cut the cord on some that aren't performing well, and just they're probably well, a lot of them are down from where I bought them, so maybe it's just time to, you know, cut my losses and move on to something that would be a better investment, right?
Hmm. Yeah, I couldn't agree more. It's again, you might have 50 positions and a few of them are growing at 3 to 5% a year versus you might have 5 positions that are growing at 10+% per year, right? And so those are the ones that, again, when the business fundamentals are intact and everything is trending in the right direction, that's where really building a large core position in those names and really leaving them alone and letting the company do what they do, right?
Yeah.
Again, back to a Costco scenario is just let them do what they do and they return shareholder value, right? They have proven that year in and year out that they know how to return value back to shareholders. I think we all saw that humongous special dividend that they did for investors to kind of just, say thank you to shareholders, which was huge. And there's a reason why, people always wonder why you're paying a 55 multiple. It's because shareholders matter and the business matters, and they prove that. Right. And so those are the companies that, again, in my opinion, that's where your money should be focused on, is the ones that are focused on growing the business while still kind of protecting shareholders at the same time.
Yeah. And also, if you're growing these positions, like let's just say 4 or 5, and you're getting that dividend, well, because you're growing it, that dividend is becoming bigger and bigger each month, each quarter, and you're able to just reinvest that so that then now it becomes bigger again, right? You're just
Mm-hmm.
adding snowflakes to the snowball, so to speak.
Yep. Yeah. No, I agree. I think some folks, I think that's the only thing I would say I don't love about X is the path that sometimes it sends people down, mainly because, suddenly a ticker starts to get talked about, and then that ticker is suddenly across every person's post. And I think that's what sucks folks into suddenly starting a position on a fund, a fund or even an individual name that maybe they wouldn't have even considered or bought, just
Or
because
even heard
suddenly
of.
we're exactly, I'll use Hershey as an example. Suddenly no one was talking about Hershey. Suddenly it was down. Then everybody was talking about Hershey. And then suddenly people are owning half a share of Hershey. And it's like, again, that's fine. There's nothing wrong with the company. It's a great company, right? But I just see that trend of suddenly a ticker just starts getting spoken about everywhere. And then we jump in and people start trying to start a position in it, right? Versus, again, going back to ignore that noise, because a lot of times that noise can really affect your investing journey. You really have to try to ignore all the noise. Just because you hold a position, guess what? There's always going to be bears that don't like your position. There's always going to be people that say you're investing in the wrong company. You don't know what you're looking at. This company's going to zero, right? There's always going to be those people. And the folks that learn to ignore that noise are typically going to be the ones that are successful. Because again, you look at most investors, they trade in and out of positions too many times. And that's, I was listening to a podcast the other day, and I don't know if you saw that study on they were talking about really the most successful portfolios and investments, and
I was
they
just going to
actually
mention that.
found, yeah, they found the people that actually had passed away were the ones that had the most successful portfolios. And all it really came down to was, again, it's because they never touched it. They left it alone. They let the market do what it does, which, as we all know, is what, 7-10% a year on average, right? But let the market do its thing. And I think I think that's the one thing that social media can sometimes affect investors in a negative way, is that noise, right? And I think to become a successful investor, you have to learn to ignore the noise. Focus on the core fundamentals of the business. You know, is the stock and the business being ran in the manner that you're looking for? And if all those things are happening, don't worry about everything else. Don't worry about what somebody else thinks about the stock or the company. If your fundamentals and research is accurate, then stick to what you're doing, right? That's just kind of the way I think of it.
So I'm just going to add to that. So a lot of it is just exactly that. It's just noise. And so, yeah, the sooner you can tune out the noise, the better off you'll be. And then kind of to add to sort of your point of people just jumping into these stocks, well, they're jumping into it just because they've seen a ticker symbol pop up on Twitter or X, 100 times in one day without doing any of their own due diligence or doing their own research. And so they don't even know what they're getting into. It's just, oh, I've seen 100 people talk about this on Twitter today, so it must be a good buy. And that's literally, at that point, you were just listening to the noise that we're right now trying to tell you to avoid, right? Just to ignore the noise. So yeah, that's sort of, I guess, what I have to add to what you've just said there about, ignoring the noise. But like I said, also do your own research, do your own due diligence, make sure you know what you're getting into. And yeah, just because people are talking about it doesn't necessarily make it a good buy. Maybe it is, but you need to determine
Yeah.
that for yourself and not have the noise from the social medias affect what your financial decisions, right?
Yeah, and there's always going to be, look, there's typically always going to be a reason for why a stock may be pulling back when maybe the fundamentals look like they're still intact or the business still looks to be, in kind of a good place. But there's always something that potentially you're missing, right? When you see a strong, great, healthy company that's down in share price and potentially down double digits in share price on a year, there's typically a reason, right? And the key is that reason might not just be right in front of your face and on the surface. And I'll use Hershey again as an example of again, there's nothing wrong with the company. It's a great ran company. The fundamentals of the business are good, but you have cocoa prices sitting at a 10 to 15-year high, which, as we know, are going to hurt margins, right? And again, that on the surface, you may just be looking at a stock price going, it doesn't make any sense. Why is Hershey down 30%? The business is great. The business is good. But you're looking at cocoa prices at 10-year highs, right? And so there's a reason that investors were selling off the stock because, again, they know that business and its profits are going to truly turn around when those cocoa prices start to come down. Now, yes, do you want to start to build that position early before those prices probably start to come down? Yeah, you probably do, right? Because by then you're trying to chase the position and build it. You're probably too late at that point, right? But I think Hershey's a great example of you have to look a little bit deeper sometimes to find what the reason is for that double-digit pullback in percent.
Yeah, that's interesting. I didn't know that about cocoa prices, but obviously, if you're making chocolate bars or chocolate anything, you need to buy the ingredients, and if the ingredients cost more, that's going to affect your bottom line. And so that, and again, like Hershey's, it's been around for well over 100 years, I believe, and it's not going anywhere anytime soon. So in the long run, yes, probably a good buy, and maybe right now, while the stock is low, it might be a good buy now while those cocoa prices are high, because as you kind of alluded to, when the cocoa prices come back down and retreat, then odds are very good. Then the bottom line is going to look better again for Hershey's, and that stock price will probably then appreciate in value.
Yep.
Probably, right? Like that, you would think
Yeah,
that would
that's
make
the
sense
hope,
if it
right?
did.
Yeah.
The market does act in weird ways, so you never know. But I mean, that obviously makes sense to you and I, just two guys talking, having a conversation.
For sure. Market does act in weird ways. Ain't that the truth? Yeah.
Just speaking again about sort of companies that have kind of taken a slide recently, I'm just kind of curious what your thoughts are on Tesla.
Yeah, I saw that. They've been pulling back pretty hard. I, you know, I I would say I'm not shocked. I mean, at the end of the day, when you have interest rates where they're at, it's going to be challenging. I think anyone could have seen that coming from a mile away. At the end of the day, yes, does Tesla have competitive, you know, uh, cars as far as the price point, especially when you start to factor in, tax credits and things like that. Like there is a lot of incentives to get EVs and get a Tesla. But, at the end of the day, how many folks are wanting to finance, a 35 all the way up to what, a $100,000 vehicle, when even on 800 credit scores, you're looking at 7-8% in some instances for folks, right? To finance that car. And so, it really just comes down to that. Do I think that, sales will start to rebound when some of those rates come down? I personally do. I don't hold a position in Tesla myself, but you know, do I think that the pressure is from that? I do. I think they'll bounce back a little bit when some of those rates start to come down. Um, but yeah, I don't think I was expecting a pullback that big. It's
Right.
been taking a beating for sure.
I just have to chime in and say I'm very happy to be still driving my 22-year-old 2002 F-250. So it's paid for,
I mean,
right?
I drive a 2004. Yeah, so and I've owned it for, I think I bought it in 2006. I still drive it and drive it every day.
So you're in my club with the 20-year-old vehicles, and I mean, as long as they keep getting you from point A to point B and they're paid for, why not, right? And there's no need to take
Yeah,
on that added car payment.
I can't let it go. I absolutely love the car. It's a blast to drive. It's one of those that it's just the look of the car will always age well, and it's kind of held that look for the last 20 years, and so I can't bring myself to get rid of it either. So
Yeah, well, and again, why would you, right? If it's still working, still gets you from point A to point B, and financially it makes sense to not add a car payment because, like you said, financing even the $30,000 car that's one of the least expensive options probably for a newer vehicle at 30. But then, yeah, you go up to very quickly, you can get up to 50, 60, and then as you mentioned, even over $100,000 for a car. And yeah,
yeah,
those
that's
monthly payments
that's
are just
crazy.
insane, right?
They are. It's funny you say that. I had a conversation actually it was probably a couple months ago on that topic of car payments and investing. It's interesting kind of how you said that because it just sparked that conversation in my head that, so many folks that are just quick to sign a piece of paper for a 500, 600, $700 car payment, but they won't invest a single dollar, right? And so when you really look at kind of the path, if people really want to get ahead, I get that question a lot. Like, how do we get to that next step or that next level? And obviously, debt is the number one reason why a lot of folks can't get that journey started. And one of the biggest questions I get too or comments I should say, is the market is scary, and I'm scared of the market, or I don't know what to do. And I think that's a lot of what's out there today, and why folks don't invest is because I do think the media sends a very strong signal sometimes that typically might not be in the right direction. And I hate to say that, but what's been on the news for the last 2 years? It's been doom and gloom, and we're going into a recession, and the market's going to crash, and expect the market to pull back, blah blah blah. And what happened? The market
And
went
all
up
this
20
while
plus
we're hitting
percent.
all-time highs, right?
Yeah, exactly. And so, I think that's why I always make that recommendation of you need to ignore the noise and stick to the path, keep investing regularly and consistently, dollar cost average into a broad-based ETF. Are you going to have a year that goes down 20%? Yeah, you are. And be okay with that. And I just think that's typically the advice I give is I would much rather tell someone to sign a piece of paper for a $300 car payment instead of a 500 and invest the other 200, right? But I think a lot of folks are it's very odd that folks are so quick to sign up for debt, but won't won't look at investing, right? To try to grow their wealth, because what they don't realize is sooner or later those dividends can be paying your car payment one day, right? It might take you
Right.
10 years, but you might have a free car payment if you think of it that way.
Yeah, exactly. I think that's a great point. And yeah, just to add to that, whether it's the car payment or credit card debt or any other type of consumer debt, it's all of a sudden you can dig yourself into a hole that is very, very difficult, nearly impossible to get out of. And then, so yeah, where does the money come for investing at that point when all you're just trying to do is make ends meet and pay off
Mm-hmm.
a credit card and have this $500 a month car payment? Now, people like you and again, we're driving 20-year-old vehicles. You and I are I'd much rather put $500 a month into my brokerage account and invest that as opposed to paying $500 a month to a car payment. But like, yeah, I've never really thought about it the way you just said it. Is so many people are so quick to just to sign that piece of paper and to go into that debt, which is, you know, I guess too, I've been there myself, and I guess I've
Mm-hmm.
just, learned those lessons and learned from my mistakes. And, when you learn things the hard way, you definitely take note. You remember the lessons when you learn them the hard way, right?
Yeah, I think you just nailed what you just said right there, because I couldn't agree with you more. Is like I think I look at things completely different now than I did 15 years ago, right? I go back 15 years. I look at I want a nice car, and I want a nice this, or I want to do this. I want to buy this cool thing just because I want it, or you just looked at a lot of things as you just wanted all these different things versus when you think about investing, like now I kind of look back versus investing and all those, is it cool to have a nice car? Yeah, but now that I look at it, it's like, it is what it is. It's just a car, right? But
Yeah.
what's really getting you ahead in life, right? Which is the investing side, right? At the end of the day, a car is a depreciating asset, right? You're losing money on just about any car you buy. It's not getting you anywhere. So, that's I couldn't agree with you more on that.
Yeah. Yeah, there's a few rare circumstances where, I've known people that are great mechanics and they'll be able to like buy say a 68 Mustang or something like that, or a 73 Corvette
Mm-hmm.
and fix it up and sell it for more. But that's not the typical person, right? Those are rare
No.
instances where that's kind of more the few and far between example. And at the end of the day, like you said, a car is a car. So it doesn't, if you're driving a Porsche, that's going to get you from point A to point B. And if you're driving a Honda Civic or a Toyota Corolla, as everybody on Twitter likes to talk about Toyota Corollas, well, they do the exact same job of getting you from point A to point B. Sure, the Porsche looks
Yep.
nicer. Sure, the Porsche sounds cooler, but at the end of the day, you're still getting from your house to work, from work to the grocery store, from the grocery store back home, or wherever else you're going, right? So,
Yeah. At the end of the day, when you're young, if folks could realize that, it has nothing to do with impressing those around you or your family or your friends. Realistically, if they're your true friends and your family, no one cares what you're driving, right? No one cares what you're wearing. You know, it, I think people try to keep up with that lifestyle, and that's truly what keeps them from kind of that investing journey, to have a little bit of a kind of extra money to be able to invest, right? Because I think a lot of folks always feel that they need the next nice thing, or I need the next iPhone, that's $1,300, when the one that you just got last year is probably just fine. And you probably don't need to get the next one right away, right? Maybe give it another year or two. But it's
or I've
I
got like
feel
a
that it's all
12-year-old
those little
Samsung,
things,
right?
right? Exactly. Yeah, it's a lot of those. Just I think people realize that they lose out on growing wealth through kind of nickel and diming themselves, right? I think some folks do make kind of big silly purchases, but I think a lot of folks too, I think they lose it by the nickels and the dimes of those smaller purchases that they don't realize just across the year truly start to add up, right? When you do want that next iPhone or a tablet or a new computer or a new TV. And it's kind of all those little things that just keep adding up, that, there was really nothing wrong with all the ones you had before. Right.
Yeah. You did mention that people don't care what you're wearing, but I care, and I think you should be wearing Passive Income Posse hoodies and T-shirts and ball caps. So go to the link in the description below. I just had to sneak that one in there.
That was good. That was good. I like it.
Awesome. Yeah, let's just keep the conversation rolling along here. We've talked a lot about your sort of your ETF investing strategy as opposed to just some individual stocks. Um, we've talked about sort of the pullback from Hershey's and Tesla, and I'm sure there's been other, and even going back sort of a year or more, you saw that big pullback with a company like Facebook, Meta, and then it rebounded again. I think Amazon was in the same kind of uh,
Hmm.
phase where big pullbacks. The smart investors bought the dip, and now they're very happy about it. Um, Obviously, I've been there. You probably have too. You buy the dip, and then you buy the dip again, and then it keeps dipping, and you keep buying the dip, and then you're like, oh, is this ever gonna rebound from this dip? Because I'm dipped out at this point, right?
Yeah, no, I think there's a lot of names like that I think you could put that into. I think Meta was a good example. I like that you brought up Meta because I do think that's a perfect example of, you look at the free cash flow and you look at the business itself, all the fundamentals were there for that to be a turnaround story. Now, did I miss that train? I did. I didn't jump on that train, and obviously, I wish I did with the run that it's had lately. It's been a phenomenal run. But when you really stop and look in the mirror, all the writing was on the wall for a success story. At the end of the day, you look at how many users they have. I mean, was there anything there that said that this model is going down? There was no sign of that, right? And so I think those are those moments where sometimes you got to look back and go, man, everything was there, right? The business model was intact, the free cash flow was intact. They're still adding users to the platforms. Advertising numbers are still increasing. Again, all of it was there. I think the dividend obviously threw everyone a curveball. I think no one saw that coming. I think it was extremely smart by Mark to do that and the board to make that decision. I think that brought in a lot of fund money that probably wasn't there before, and I think that's why we saw the size of the run that it took. I think you had a lot of large funds probably increase that position pretty largely once that dividend was kind of added on top of that. But no, I agree with some. I think Realty Income would probably be a good example of the dip that keeps on dipping, and you keep adding, and you're like, is this thing going to keep on dipping? Realty Income always kind of blows my mind when I think about that stock because again, all the fundamentals are still there. You look at the acquisitions that they made with Spirit Realty. But I think the commercial real estate side, as far as office office space, it's kind of silly when you think about it, because when you actually dive into Realty Income and you look at their portfolio and you look at their current holdings, their office exposure is almost non-existent. And so you have a company that's fundamentals are still there that's really being dragged down by the entire REIT sector getting pulled down just due to the kind of office space risk that people don't want to take. And they really don't have that same risk that people realize. But I think a lot of folks, again, it comes down to they're not actually diving into what are the actual holdings and properties that Realty Income is holding. And you would realize if you dive into the shareholder letters and look through the slide decks, you would see that their office exposure is almost non-existent, right? And so that's why you see stocks like Realty Income that are continuing to take a pullback. But then you have stocks like a Simon Property Group that, again, as we all know, is mall properties and typically more of a premium mall properties. That stock has continued to perform. That is a holding I personally own myself. It's done tremendously well. I think it dropped down into the 100 range. I think it's upwards of 150 range, somewhere in that right now as well. But I think that's an example of everyone knows Simon Property Group as mall holdings, and so they realize that their office risk is probably not there, right? And so the stock has continued to perform and perform well. But then you have, again, a stock like Realty Income where it's pulling back really for no reason. I don't even think we've really seen things come forward with the Spirit acquisition. I don't think we've really even seen what those numbers are going to truly do to the bottom line. I don't think the Bellagio piece added into that has really started to come to fruition either. So, you really look at the price of AFFO, in my opinion, I mean, I still think it's in a good range. And then I obviously I got a position in realty myself. So,
Yeah, so just to kind of add to the REITs here in Canada, as most people know, I'm overexposed in the REIT sector. I bought in a lot of them in 2021. In 2022, I looked really, really smart because a lot of them were like on the rise and rising. My bet was, COVID, eventually people are going to go back to the office, and I didn't just have office retail. I had, like I said, I'm overexposed. Right? I have office retail, everything, like everything warehouse, all the REITs basically.
yeah,
I'm overexposed in the sector. But and then what happened when sort of inflation hit, and then in the US the Fed started raising interest rates. Here in Canada, the Bank of Canada started raising interest rates. And well, these REITs that rely on mortgages and that type of financial structure, well, they started getting hammered because their interest rates were all of a sudden way higher than they'd been in whatever it was, 25, 30
yeah,
years, right? So um, that is probably part of the realty income story as well. So honestly, this I don't really know much about the other group you mentioned, Simon Property, but if they're still doing well through all of what all the other REITs have gone through, then I would say that is impressive, right? That they're on the right track, because now that eventually, I mean, I'm not sure in the US. I think the Fed has been holding the rate. Here in Canada. The BOC, Bank of Canada, has been holding the interest rate for several months now, like a long time. And eventually, it sounds like when they're sort of happy with where inflation is again, they'll start to lower them again. And hopefully that, leads to a huge recovery in the whole REIT sector, because I am still holding a lot of them. And obviously it would be nice for them to appreciate in value again, and some of
yeah.
them. I had several dividend slashes in those REITs as well, just because of that exact
Yeah.
scenario that I just mentioned, right? So
Yeah,
yeah,
Simon, I think what makes Simon Property Group unique is they typically are going to be on the side of more premium properties, premium as far as typically going to be higher end places. So, like in Las Vegas, as an example, I think Simon Property Group owns I think they have the mall that's in the Aria in Las Vegas, and so again, more of kind of your premium, higher end properties that typically have higher end consumers, and those properties have done well. But to your point, you look at like a WP Carey as an example, right? I think we all saw that. What was that, about 6 months ago? And I think we got not only a dividend cut, but then they also spun off the office sector into, I think it was NLOP, if I'm not mistaken. But basically cut out the entire office sector of their entire portfolio and spun it off into its um, own company, because they didn't want the exposure and bringing down kind of the core business. So, I think WP Carey is another great example of a stock that's taken a huge hit. But if you look back, Office was already spun off, right? And they tried to get out of that as quick as they can, because they obviously saw the same risks as well. But yeah, I agree with you. I have a few REITs myself that have been hit pretty hard. I have WP Carey also. And that one's been hit pretty hard in the last year. But,
yeah, and just hopefully, as the interest rates begin to decline again, that, like I said, hopefully there's a recovery in the REIT sector. Residential as well.
mhm.
That's what I was. So like I said, I have sort of across the board in REITs: residential, retail, office space, warehouse space. It's like too much, all of it. It's like I kind of, you know, sort of going back to 2020 and 2021, I was sort of pushing the chips all in a little bit on REITs. And In retrospect now, I would have sort of divvied that up a little bit more around to different
Hmm.
sectors. I do still have exposure in other sectors as well, obviously, but yeah, I was pushing the chips in a little too hard in the REITs. Again, of course, hindsight is always 2020. You can always look back and say, "Oh, I should have done this. Oh, I should have done that." But you
Yeah.
can't focus on that either. You can't change the past, and you can't unring that bell. So you just have to kind of live with it and live with your decisions, and either cut the cord and take your losses and move it into something else, or just sit and wait and hope that something in the future changes for that sector and these individual companies, right?
Yeah. No, I agree 100%. Yeah.
Wow, already 45 minutes into the conversation. It's been awesome talking with you. I do want to just bring up a few more topics. Um, Obviously, you're in the US. As everyone knows, I'm in Canada. So, do you follow any of the Canadian um, companies? Or I know on Twitter, like basically the biggest topic is Canadian banks, probably. So I'm sure you've heard about the Canadian banks and whatnot. Obviously, I do invest in some of them. I think actually in one of my ETFs, all of them are in that basket. So yeah, just any thoughts on Canada, the Canadian market? Do you know much about it or anything about it?
I don't. I don't have any Canadian positions. Don't have any Canadian banks either. No.
Yeah, okay. Are you ready for the skill testing questions?
Sure.
Well, I do like it's just a little bit of trivia. So the first Canadian bank started paying a dividend. Bank of Montreal started paying a dividend in 1829. Uh, so going on nearly 200 years. In 5 years' time, it'll be the 200-year anniversary. Bank of Nova Scotia, I believe, was 1833. So again, in less than 10 years, will be a 200-year anniversary. CIBC and TD were around the 1850s, and Royal Bank started paying a dividend. I believe it was in 1870. So all
Wow.
five of the big five Canadian banks have been paying dividends for over 150 years, and some of them close to 200 years. So the skill testing question, keeping in mind all of those dates I just mentioned, 1829, 1830 something, 19 or 1850s and 1870. What year did Canada become a country?
Oh man. Oh. Um, let's go 1810.
1867.
Oh.
Yeah. Yeah.
That's
Actually,
incredible. That's crazy. I didn't know that about those banks. That's incredible. 150 to 200 years. That's awesome.
yeah. So, I mean, just the longevity of paying a dividend. And I mean, obviously, there hasn't been a dividend increase every single year, but just the longevity of paying a dividend for
Yeah.
150 to 200 years is
That's
just
that's that's incredible.
yeah. There was one person just recently on an episode that got the question right about what year Canada became a country, because he was like, "I knew you were going to ask," so I had he had Googled it or something, or he got the answer from one of the previous episodes. So um, I just think that's amazing, right? Canada becoming a country in 1867, but these banks were paying dividends for 20, 30, almost 40 years prior to that. So
Yeah, I think
just
that's what
crazy.
threw me off a little. Yeah, oh, that's where I kind of went way early. Yeah, that's
Yeah.
crazy.
Awesome. That's been fun. So before we wrap up here, I just kind of want to open the floor to you. Is there anything else, any other topics that you want to discuss that we haven't talked about yet?
I guess I got one question for you. I guess we'll flip it around a little bit. As
Sure.
far as obviously we're both into dividend investing, but what's your view, or do you have any views on any speculative plays that you hold today? Obviously, I have a few names that I hold that are a little bit more of kind of my, I guess you could call them dice roll stocks, right? And what about you?
Yeah, so I think I still have one that is not a dividend payer, and it is called Standard Lithium. I believe the ticker symbol is SSL on the Toronto Stock Exchange. And so basically that was sort of my play into the EV market, because I'm thinking,
Hmm.
It's going to take a lot of lithium to make all of these EV batteries. So, in my mind, it's a smart sort of long-term play. And it's a small position, like 10 or 15 shares that I bought at like $3 a share. And at
Yeah.
one point, I believe it was up to like maybe $13 a share. And of course, I'm talking in Canadian dollars, but, and it's kind of retreated back to that $4 and up to six and sort of, trading all around wherever. So, yeah, but that's sort of my sort of small little speculative play on lithium, with the idea that, if what the government say they want to do and have like EVs mandated by 2035, well, it's going to take a lot of lithium, to produce all of these EV batteries, and so that's my logic there. What I
Yeah.
don't hold, and it's not really speculative, but copper as well. I really think,
Hmm.
copper is a good idea because, it's something like, what is it, 6 times as much copper, or maybe even 10 times as much copper needed to make an electric vehicle as opposed to,
Yeah.
an ICE vehicle, internal
Yeah.
combustion engine. So, I don't hold anything has anything to do with copper, but, it's sort of similar idea there to the logic behind the lithium.
Yeah. No, that makes sense.
Okay. Well, yeah, throw out some of your speculative plays that, you're just kind of rolling the dice and see what happens.
Yeah, I think my first one would probably be Planet Labs. Was one that I've held for quite some time. The actual platform is very intriguing, and it's something that it's really been, the platform has been growing, but what they basically do is they do satellite imaging and scanning of the Earth. And so what they do is they do take a full scan of the Earth every single day. I can't even remember how much data they have, but last I read, it was in the terabytes because they've been scanning the Earth, I think, every day for I don't even know how many years. But basically, what they do is they take this data and they sell it to government entities and things like that because it does things from carbon mapping and it actually they're starting to bring AI into basically being able to sort through all that data. If you actually see on the news or CNN or anything like that, and a lot of times you see a lot of these satellite images of maybe the Ukraine war or a forest fire or something like that. Actually, a lot of times it's Planet Labs imaging that you're actually seeing in those pictures. So what they do is they sell a lot of that back to government agencies. So I think that's probably one of my more speculative plays, hoping they can make it profitable here pretty soon is obviously the goal. That's probably one of them. And then another one that I've really enjoyed that I've been starting to build a larger position is a company called Clearwater Analytics. This is a company that what they do is they basically have software that manages the assets of really large corporations. So you can think of companies like Starbucks or JP Morgan, Bank of America. I think they just signed with T. Rowe Price, if I'm not mistaken, a couple of weeks ago. I think they're pushing upwards of $7+ trillion flow through their software. But basically, what their software does is it takes every asset, I guess you could call it, and everything, basically every piece of that you own. And really what it does is it filters all of it for the corporation. So, if you have money coming in different currencies and things like that from all over the world, it creates kind of an all-in-one comprehensive software that really sorts everything. I would say Clearwater is probably my AI play that I think some folks don't see, mainly because the way they're using the data is very interesting because their AI is what I look at as truly AI, right? Because what's neat about it is if I sign up as a company to use their software, all the data and information that's used actually helps another company as well. So all the data is helping each other. It also shows your risk exposure. And so I'll use the 2008, 2009 kind of great financial crisis, right? As some sectors were crashing or going down, right? a lot of times the question, you could watch it in their investor deck, but the question came up back then of like, hey, what exposure do we have, with this sector collapsing? And a lot of times with old accounting software, it might take days to weeks to figure out the answer to how much exposure you may have somewhere. But with their software, it really is, the goal is, a couple clicks of a button, and you can figure out what your true exposure is to any sector. So yeah, I'd say Clearwater is kind of I'd say it's like my AI play, so to speak. And yeah, those are probably my two companies that. Clearwater does have free cash flow. Planet is I think trying to get to profitable this year. So
Yeah, those definitely sound like two interesting, potentially companies that have potential in the future. So we'll keep watching those. I am going to give a quick shout out here. Please be sure to check out buyinvestingshirts.com. You can receive a free passive income posse. Turn that cash register around coffee mug, just like this one. With any purchase over 100 Canadian dollars before taxes and shipping at buyinvestingshirts.com, use code word Posse for 5% discount on your purchase. Link in the description. Danny, thank you so much for coming on and spending time with me on this episode of the Passive Income Podcast. I know before we started recording, you said you still had to get out for your run today. So I won't, we don't want to take up any more of your time. Let you get on with the rest of your day and get out for your morning run. So thank you so much for
I
being
appreciate
here.
it. Yeah, thank you.
Awesome. And yeah, definitely, if you are still here nearly an hour later, please be sure to hit like and subscribe.